You're watching Russell's 2014 Institutional Mid-Year Market Outlook. I'm Rachel Carroll, and I'm here today with Erik Ristuben, Russell's Chief Investment Strategist. Erik, thanks for joining us.
You bet.
So let's start big picture and talk about the first 6 months of 2014. It's been a record-breaking year so far, with the Dow Jones Industrial Average closing above 17,000 for the first time ever, coming on the heels of a very strong year last year. So talk a little bit about if you think the U.S. market has come too far too fast.
I think it's come a long way, and I don't expect it to go a lot farther. What typically happens in this part of the cycle, as we know, is you see good economic data, and we've had good consumer numbers, we have good business spending, inflation is low. I mean, in general, other than the first quarter that was weather dominated, we've seen actually strong economic activity in the U.S. I think people have brought stocks higher based on that, but you're going to have to actually see earnings in the second half come through. We're in the earnings season now for second quarter. We're going to need to see good earnings this quarter, next quarter, and into the next quarter, because at the end of the day, the market's pushing valuations beyond current earnings. So earnings got to come in and backfill.
Right.
But we think it will, but we don't think it's going to be this rocket ship ride like we saw last year.
Right, right. So you're still sounding pretty optimistic. Can you tell me, has very much changed from Russell's outlook from the first 6 months of the year to the next 6 months of the year?
Actually, not a great deal has changed. You know, we were most confident in the U.S.'s ability to maintain its economic expansion. The first quarter and the weather tested that, but I think it's pretty clear the second quarter numbers are very strong. The Fed has indicated that they think it's actually quite strong as well, which is important. Europe is struggling, right? We're looking at 0.5% to 1% growth on the year in Europe, and they're struggling to get that. Draghi in June went through in some pretty extraordinary stimulative policies, and I think those are built to kind of help address some of that fragility, and I think you're going to see that. I think China is slowing, but it looks like the rate of decline is slowed, if not stopped. And we think they are going to hit their 7 to 7.5% growth target. So economically and market-wise, we're pretty much where we were at the beginning of the year.
Okay, all right. So let's talk a little bit about equity and fixed income strategies. So in January, you said that equity investors should expect a good but not a great year. Fixed income was looking a little bit less rosy, with kind of low returns for bond investors and maybe zero returns for cash investors. Is that similar to what you're seeing now?
Yeah, basically. Well, you know, obviously the thing that has surprised us, and we're not the only ones, is that, you know, we expected rates to move up throughout the course of 2014. At the beginning of the year, we thought 3.4 was going to be where the 10-year ended up. We still don't think it's out of the question, but it looks to be on the high end of the likely range at this point.
Okay.
But so, of course, with that being the expectation, the first thing it did, they fell. And they've been kind of stuck there. We do believe they're going to rise, and obviously in a rising interest rate environment, that does push some pressure on bond prices and therefore the total return potential of bonds. 2.5% to 3% is kind of what I've been saying all year is the good return estimate for like an ag portfolio. I think that's probably going to come in. Cash is going to give you zero. Fed's telling you over and over and over again it's going to give you zero.
So let's talk a little bit about that interest rate target that we had set at the beginning of the year at 3.4%. Yeah, like you said, rates have stayed low. Can you tell me what you think the impetus is going to be to see that expected rate rise through the next half of the year?
I think there are a couple, and they haven't manifested. We would have expected these to manifest themselves already, but I think they're going to. The first one is, you know, we're getting closer and closer to the Fed raising interest rates, right? They've decided now that they're going to stop QE in October. So if you go back to the literal words of 6 months after we stopped QE, rates are going up. That's Janet Yellen. I think she was misinterpreted, but that's what people thought. That gets you in April. Now, we think it's probably going to be more June, but at the end of this year, that will be 6 months away. And so you have to be thinking that money, the price of money in terms of interest rates is going to be going up. That should put upward pressure on interest rates. The other thing is, the reason that the Fed is comfortable doing that is economically, there's stability, there's growth, there's improved employment. All the things that they're kind of looking to do, all of those things should also create a bid for money and also push interest rates up. Then on the other side, there's a massive bid for these long-dated, you know, pension funds that are de-risking in LDI structures, insurance companies, banks. All those people are buying these treasuries and keeping the rates, you know, kind of keeping the upper end of how high they can go, probably much more limited than a lot of people feared a few years ago. So up, but not extraordinarily.
Okay. So let's talk about how we are positioning our fixed income strategies in preparation for that expected rate rise.
Well, we're overweight credit, mostly through like non-agencies. We're looking at the spreads of investment grade, and those are pretty tight. High yield are tight. We're exposed to them. but in a clipping the yield kind of way. We're not looking, obviously we're not looking for incredible price appreciation, or we're not looking for spreads to narrow considerably. So it's kind of a clip the coupon type of thing.
Okay.
In currencies, we like the dollar and we like the peso, and we're short, things like the Aussie dollar, the Japanese yen, and for whatever reason, the Swedish krona, we seem not to particularly care for. So, we're making some interesting plays. And then on duration, as a general rule, we're pretty tightly band, plus or minus 0.3 in terms of duration against the ag, but right now we're a little short.
Okay, all right. So let's switch gears for a minute and talk about equity strategies. So you're positive on equities. Can you talk a little bit about how we're positioning our equity strategies in terms of what sectors we like and what we're thinking about there for the next 6 months?
Well, we're pro-cyclical, so we do like the cyclical side of the equation. I think probably the biggest bet or the biggest exposure within our equity strategies right now is not for something, it's away from something.
Sure.
We're underweighting interest rate sensitive stocks. So we're underweighting REITs, we're underweighting utilities, and that's been so far this year painful. It was not painful last year, but it has been painful so far this year as rates have come down.
Right.
We expect them to rise, so we still maintain that underweight.
Okay.
And I think that's probably the biggest thing. But otherwise, we're basically pro-cyclical sector exposed, things like consumer discretionary, things like financials, things like energy.
Right.
In general terms, we're overweight Europe.
Okay.
And we're overweight emerging markets, and in general terms, that's where we're at. But there's not a lot of valuation differences except for EM.
Right.
Out there. There's not a lot of cheap things out there.
So let's talk about EM in detail for a minute. So I work as a consultant, and a lot of my clients last year were really worried about emerging markets. They didn't perform as well as the developed markets did. This year seems like it's been maybe a little bit better. Talk about our outlook there for the rest of this year.
Yeah. So EM, if you kind of look at it in a classic valuation cycle and sentiment perspective, valuations of emerging markets, they look cheap, right? They look attractive. They have looked attractive.
For a long time.
Yes.
We've been saying that for a long time.
Well, and a lot
You've
of people
been saying that for a long time.
I've been saying that for a long time. And I'd really like the market to actually begin to agree with it.
Yeah.
The cycle standpoint, there have been some cyclical headwinds, some cyclical tailwinds on balance. The cycle hasn't been hugely supportive for emerging markets, but it hasn't been hugely negative either.
Okay.
What's really been atrocious, or at least last year was absolutely horrible for them, was sentiment, right?
Yes, right.
Price momentum, kind of, cash flows, any measurement of sentiment that you could have was very, very negative for emerging markets, which really kind of put a hold on our tactically liking them.
Right.
Right now we're at a point where we're tactically we've actually upgraded to neutral on emerging markets. And if your time horizon is 12 to 18 months and you can live with being right but early, we think it's actually a pretty good bet. And that's actually what I think you're seeing in some of our equity strategies as to why they're maintaining an emerging overweight.
Compared to some of the other places, there might be some more upside potential there.
Yes.
Yeah. So let's talk back to the portfolio level for just a minute here and talk about our multi-asset strategies. How are we positioned there on a holistic basis?
On balance, overweight equities, underweight fixed income, and overweight cash. So kind of some of the underweight to fixed income is just put into cash because we're trying to get duration neutral, and then we're doing some things within that. We're buying loans in those strategies, bank loans, which don't have interest rate dependency.
Right.
Because we're a little concerned, obviously, about interest rates. We're underweight commodities. We're underweight REITs, although our commodity underweight is moderated pretty significantly throughout the course of this year. So it's actually a much smaller underweight.
Come back to neutral a little bit.
Coming closer to neutral. Underweight real assets, kind of overweight in the U.S. and really thinking about balancing out the portfolio risks.
Okay, all right. So if there was one key message that you wanted our institutional audience to take away from this mid-year market outlook, what would that be?
I think that you should expect in the equity market a very similar market in the second half of the year that we've experienced in the first half of the year.
Okay.
I'm not surprised by how the market's behaved this year. I think in the bond space, I would expect a different marketplace. I do expect rates to start moving up.
Okay.
Again, not a toxic environment.
Right.
But one where
slightly different than what we've seen.
Slightly different than what we've seen. And I think you just got to constantly keep your eye out for reasons that maybe the forecast is fundamentally flawed. Portuguese bank issues, things that are happening in Iraq, all those things need to be taken into account. But as we've learned over the course of the last 6 years, these what appear to be real crises often don't become important enough to actually change the results of the capital markets.
Right, right. Well, thank you very much, Erik, and thank you for joining us for Russell's 2014 Institutional Mid-Year Market Outlook.